To kick things off, Bob, what are some effective strategies for developing a trading process that minimize losses?
Okay, so a lot of people answer this question by scalping, okay, by being in the market for short periods of time. And that does work, but I want to stress to everybody that scalping isn't necessarily as low risk as it used to be. And the reason I say that is because the shorter time frame, shorter spreads, larger position size that you're in the market, you expose yourself to high frequency traders. Now, they're not looking for you. Okay, there's this myth that traders and brokers are out there stop hunting. Okay, that is a myth. But basically, events happen that cause high frequency systems and traders and algorithms to blow out positions. And when you're in very tight markets, you're exposed to that. Okay, the markets are very, very large. So my first piece of advice is always expand your ranges that you're looking for and shrink your position size. Okay, if I have one share on and I have a $1 loss, okay, that's very tight. If I have 100 shares on and I have a $1 loss, that's $100 risk, right? That's the exact same amount of risk if I have 10 shares on and I have a $10 wide move risk. It's the same loss. So it's essentially the same trade. And given that with my method, I never take a trade unless it's at least 1-to-1. If you have 100 shares on and you're looking to lose $1 or make $1, you're either going to lose $1 or make $100. In my case, if I have 10 shares of $10 risk and $10 reward, it's the exact same trade, except you're not at risk with these moves that happen like this. They're so fast that you're unable to respond to them or predict them. So that's my first piece of advice to people. Position sizing is the number one thing. Okay, when you talk about developing a strategy that minimizes losses, you have to focus on position sizing being the first thing that you try to dial into, okay? And then you have to understand the difference between risk capital and the money in your account. So what do I mean by that? Well, if you're trading stocks and Reg T margin is available to you, and let's say you want to trade $1,000, you really only have to put 500 in the account, right? 500 is what's in your account. 1,000 is your risk capital, right? They're two different things. Risk capital is the total amount of capital you're willing to commit to this process, to this education, to this method. All right. So if you say, well, I'm going to put $500 in my account, but I've got another 4,500 on the side that if I lose, I'll put it in there. Your risk capital is $5,000, not 500. Okay. So that is a critical difference for when you're developing a process that minimizes losses, because you don't want to compare it to the amount in your account. You want to compare it to the total amount you've committed to your learning and your process. All right. Number two, I would say set stop loss orders and determine the maximum amount you're willing to lose on a trade. Now, many people take that as saying, well, I only want to lose $100. I entered at 200, so my stop loss is at 100. No, that's incorrect. All right. And this takes us to, it takes us to another question, but so I'll get back to that. And then based on the research you've done on your entry method, okay, decide on a risk per trade and reverse engineer it into a percentage number. Now, I've talked about that a lot. All right. And what do I mean by that? Well, you should be looking at percentages, not dollars, in terms of risk and gain. Why is that? Well, Ben already asked a question. How do you stick to your process? I have a good one for me, but I'm having trouble sticking to it. If you're looking at percentages, Ben, all of a sudden it's very easy to not worry about how much you're down. Okay, because if I tell you you're going to be down $1,000, maybe that stresses you out. But if I tell you you're going to be down 1%, okay, sounds completely different. You're not looking at it in a dollar amount. You're looking at it in a percentage. All right, percentages are much easier to manage than dollars are, because when you're seeing dollars, you're relating them to expenses you have in your life. Wow, I'm down $500. That's almost 25% of my rent, or that's my whole car payment. That's a lot of money. But if you're committed to, let's say you've committed to $50,000 to this process, okay? And let's say you're down $500, right? $500 divided by 50,000 is 1%, okay? So you're looking at a 1% loss. And 1%, that's the way you stick to your process, okay? Now, there's issues with that, some people, but I'll talk about that when we get down to specific tools you can use, okay? When I talk about reverse engineering, okay, here's a verbal example for you guys. $5,000 in risk capital, okay? So that's the money you're willing, it's not the money in your account, it's the total money you're willing to risk before you say, you know what, this experiment failed, I'm not doing it anymore, all right? $5,000 in risk capital, I'm only comfortable losing $150 on any trade. $150 divided by $3,000 equals 0.03 or 3%. That's your risk per trade. Okay, so you're reverse engineering it. You start with the dollar amount that you know won't make you vomit. Okay, some people, they get actually physically ill when they're losing money. So say, okay, if I lose this much, I'm not going to throw up on my computer keyboard. Okay, and then you reverse engineer it into a percentage, and then you stop looking at the dollars after that. So now what happens is, as your account grows and as your risk capital grows, you risk more during winning streaks and you risk less during losing streaks in dollars. But it's the same percentage all the time. And we've done entire episodes on that. So I suggest that you reach out to TradeZero and Badish and the team, find where those are and watch them if you're new here. If you're not new here, you've heard me say this over and over again. So those are the strategies you need to start with.
Thank you for your wide work, Bob, as always. Thank you, Ben, for the question. You already mentioned the entry and exit points. From there, like, how can traders identify and manage risk to minimize losses in their trading activities?
So you want to dial in on your method of stop discovery. Okay, so what a lot of people do is they say, I'm going to look for a system that makes money. And that is logical to do, right? It makes sense. You're not stupid if you do that. Okay, but a lot of people will say, I'm going to look for something that makes money. And they'll say, the RSI reaches above 50, I got to dip to support, and I got to move higher. That's a system that makes money. By the way, I'm making that up. I don't know if it is or isn't. But you don't look at drawdowns while the trade is going to a money win, right? Turning into a winning trade. You don't look at the drawdowns. Okay, so within that context, where does it turn around yet still work? Okay, so what's the average range of a dip before it goes to its target? You need to dial in on that. When you have a method, you need to dial in on the stop discovery. And stop discovery consists of the spot where your thesis is proven incorrect by price action. Your thesis may still be right. Okay, so if you have a thesis, you say, Tesla is way ahead of every other electric car maker, and the market will soon realize that, and Tesla will go back up to 600 a share. All right, that could be correct, but maybe it goes to $5 before it does that. All right, and if it does that, you're probably going to get stopped out. I don't care where you bought it. If it goes to $5, you're probably getting stopped out. So you have to find a place where the price action proves your thesis to be incorrect. I'll give you an example. I was on Bloomberg, it was actually Bloomberg UK once, with an analyst from Morgan Stanley. We were talking about the British pound. And I said the British pound was going to go to this level, and he said it was going to go much, much higher than that. Okay. Now, I'm sorry, I said it was going to go down to a level, and he said it was going to go much higher. We were on together, split screen like you and I are right now about it, Badish. And I said, yeah, it's going here. And he said, no, I disagree with Bob, it's going here. Okay. About 6 months later, they had us both back on, and it was at the analyst from Morgan Stanley's level. And they said, so, Jans, you were right. What do you have to say to Bob? But it went to my level first. It went down to my level first. And I said that. I said, look, I put on a short trade and I exited at the level I told you guys. It's not my fault that you didn't have me on when that happened. And then, yes, it eventually turned around. But in the amount of time since I got my short trade profitable, I've also put on 2 longs and enjoyed the same move. Not because Jens said it would, but because that my process is shorter term than Jens is, right? 2 things can happen at the same time. So your thesis can be correct, but you might get stopped out because of your risk. So you need to dial in on your stop discovery. You need to pick where you have to reassess your position, and then you have to stick to that. The second thing is know the answers to what and how. I've said this in these sessions before. Why something is happening is not important. Why is the weakest question that an active investor or trader can ask. When you look for the question why, Ben, why is this moving? Why is it moving against me? And you start looking for news or maybe a piece of data that you missed that'll help you stay in the position. You don't need to, it doesn't matter. Okay? If you have a dishwasher in your house and it's running and it's cleaning your dishes, okay? And all of a sudden your kitchen floor starts flooding out of the bottom of the dishwasher. You don't stand there and go, why is this happening? Why? Maybe it'll fix itself. You put towels on the floor and you turn the machine off and you turn the water off. That's the first thing you do because you want to limit the damage. Okay? You need to limit the damage. And then you open the dishwasher up and say, okay, now what happens? So why do I say the what and the how question? What's happening and how am I supposed to respond? Those are the 2 strongest questions that an active investor can ask. The why question, leave it for the weekend. Okay, leave it for your conversations with other traders. Leave it for, your conversations with support at TradeZero. Don't ask yourself that question while you're in a trade. Know what has happened and how do you react. And then lastly, for this question, do not adjust while a trade is open. And I mean, do not adjust your process. If you have an open trade, stick to your process. I don't care what you've done in that process. While your trade is open, you stick to it. Tweak your method only after you're flat and when you've had time to research the tweak you want to make so that you have data to back up that twist or tweak, that change. Okay? Do not do it while you have a trade open. You will blow your account up. It may work for a trade or 2, but if you keep doing it, your account will blow up. You'll close your account out. Stick to your process, especially if you're listening to me in these sessions and you're saying, okay, I'm going to change the way I look at things. I'm going to manage my risk. Profits, I'm not going to worry about until I've learned how to manage my risk. All right. A lot of people, you go into demo mode and you practice making money. Practice not losing money or practice losing comfortable amounts of money first.
Thank you for your words, Bob. We have coming questions from Chris. Hi, Chris. Does that include not raising your exit while it's rocketing?
This is a fantastic question, Chris. Thank you for that. So by the way, you guys may ask questions that I forgot to address. And that's why you should never feel shy about asking questions. If you're shy about asking questions, put a fake name in here. Okay, call yourself Achilles or something. I don't care. This is a fantastic question. Chris, you only adjust your profit target if you plan to do it before you put the trade on. Because what happens a lot to people is they go, wow, this is moving faster than I expected it to. Time is not a very strong thing in investing. Okay, because time makes you think differently. All right. I think this should be happening slower. Because it's happening faster, that means it's stronger. No, it doesn't. It could be a panic exit by shorts or by longs. Okay, it does, and I'll point you to one right now. I don't have my system open, but take a look at Snowflake. Okay, Snowflake gapped open after earnings yesterday, and it is collapsing now. Okay, I just looked at it before we went into the session. It is a big red candle down. So let's say that your exit was, by the way, I never trade in the post market. So I'm looking at the post market. I don't have a Snowflake position, but let's say I did. I'm looking at the post market and going, wow, this is going to run tomorrow. I better up my target so I can make more money. Do not do that because it opened up and collapsed, right? So maybe my target was in that opening range. Now, here's another reason why. That is greed focused, okay? That is greed focused. That's not risk focused. This entire experiment that TradeZero and Bob Iaccino are doing is to try and get you guys to be risk focused because we want you to trade for years, not for weeks, not for months. TradeZero wants to go out to the public and say, our traders don't blow up. That's why we're better than everybody else out there. Our traders don't blow up. We have a lower turnover of accounts than any other broker out there. That's their goal. That's why I'm here. Right? Otherwise, why would they want to talk to me? I talk about the most boring shit in the world. It's about risk, right? But they want to go out there and say, our traders last. That's what you all want to do. Well, Chris, that is a fantastic question. Thank you for that.
Chris, thank you for your question again. And as you mentioned, the process, sticking the process what we built, what's the role of the psychology in this building process, trading process?
Unfortunately, it's everything. It's absolutely everything. Okay, because the first thing that a trader, like Ben and Chris said, not just you, Ben, so he's commiserating with Ben on having losses when he feels like he shouldn't have. Unfortunately, psychology is everything. And when you've lost a lot of money trading, and I have had this experience, I've told you guys before, I lost close to 6 figures in US dollars in less than 9 months. Okay. When my first attempt at trading. And that's when I started to adopt this. Okay. That's when I started to say, okay, I've only got one more chance to do this before my father digs a hole and buries me in it after he kills me. Okay. I've got one more chance. I've got to protect my capital. All right. And you guys should be thinking that way as well. Now, that doesn't mean you trade from fear. It means you trade from confidence. And when you've lost money before, it's very difficult to get that confidence back. So you have to refocus your thinking into, I have succeeded if I've stayed within my risk. That is success. Okay. Now, for a lot of you, that's going to cause you to take very tiny risk percentages. And I agree with that. Okay. I agree with you doing that. But all that means, I'm going to try and change you to say, take small positions and bigger risk percentages. Because as I explained at the beginning of the session, the math is the same. On 100 shares, if you lose $1, you've lost $100. On 10 shares, if you lose $10, you lost $100. It's the same math. This is the simplest thing. And people don't think of it that way. They think, well, I have to do 100 shares because I want to sell covered calls against it. And one step at a time. Okay, put one foot in front of the other. Don't try to jump 10 feet before you can even walk. Because this is a trade. Trading is a trade. Okay, the very first time a young electrician goes on a job, they don't allow him to wire up an entire football stadium. Okay, they have him do a house. All right, it's baby steps. The first time a doctor does a surgery, they don't have him do a brain transplant. Okay, they have him suture a cut. Baby steps, just like in everything that matters, you want to go slow. Here's the second thing about psychology. This part's going to not upset you, but it's going to make you frustrated. You can't change it. It's never going to change. Okay? I've been doing this since 1993. In September, it will be 31 years for me. I still found myself saying, damn, I could have made more on that trade. And then I take this water bottle, which is steel, and you can see it's kind of scuffed up. That's from me smacking it into my forehead when I say that. I also have a big forehead because of it. One of the things that helped me, and I don't know if it's going to help you guys or not, is when I put on a trade, I have a target and I have a stop. I try to walk away. Now, maybe I miss other trade opportunities, but I try very hard to leave the screen. But you can't change your psychology. You can only control it. I don't know if you guys know who Michael Jordan is, but I grew up watching Michael Jordan play. Okay. I was graduated high school in 1984, and he was drafted by the Chicago Bulls in 1984. Okay, so I saw every one of his games, a lot of them live. Luckily, I was making a lot of money by the time he was Michael Jordan in the 90s, and I was able to buy tickets courtside and go see him play. The big thing about Michael Jordan was they used to say, you can't stop him, you can only control him. So let him score his 40 points. We'll stop the rest of the team. You can't control your psychology. You can't change your psychology. You can only control it. Human beings, we use our lizard brain. And our lizard brain is about sex, shelter, and food. Those are the three things. And then the lizard brain also has fight or flight. That brain is what you use in trading, and you have to bring it down to the neocortex and try and get other parts of the brain to trigger as well to help control the lizard brain. And it is only about control. It's not about fixing it. I'm sorry, guys. I wish I had better news for you.
Insightful. Thanks, Bob. And my next question is you already mentioned at the beginning of your speech, the tools and the software. So are there any specific tools or software that traders can use to optimize their trading process and minimize the loss?
So there are some things out there. The first thing I would look for, and I'm not going to recommend any, is to look for a tool that calculates the K ratio of your trading. Okay? K ratio is a very important tool, and I don't know of any broker that provides it, so I wouldn't expect that you guys do. But you can go out there and find a K ratio tool. And what you do is you enter your data into the tool, and it calculates the probability of you making money over time in terms of your current process. So if you get a K ratio of 1 or better, that means you're going to make $1 or more for every dollar that you risk. Okay, now you usually need about 90 days of data, okay, and a bunch of different pieces of, a bunch of different trades in that 90 days. It can't be 2 trades in 90 days, but it's called the K ratio. I had a business partner create a tool like that. That's the number one tool because the K ratio tells you how your risk-adjusted returns are going to look over time or should look over time. This is a very hard question to answer because without knowing somebody's strategy, it's very difficult to tell you what tools to use. The second best thing out there is an Excel spreadsheet. Okay. And if you don't know how to use Excel, there are very cheap courses, sometimes less than $50, where you can learn Excel basics. Okay. One of the things I do with Excel is I convert all of my trades into percentage through Excel so that, and then you can get Excel to load data directly from your broker when you're trading live. You can get live data into Excel, and you can build an Excel spreadsheet that shows you whether you're up or down by percentage, not by dollars. All right. So that's a very, very good tool. You can also keep track of long and short trades on separate sheets, not separate spreadsheets, but separate tabs at the bottom. So what do I use that for? Well, sometimes I've told you guys before, my average hold time is about 26 days. Okay. Sometimes I have a trade. Let's use Tesla again, just as an example. All right. Let's say that I have a long-term long trade on Tesla. Okay. And I've been in this thing for 15 days or so. And now I've got a short-term short trade on Tesla. Okay. Now I say, well, I mean, I'm long. What am I going to do? Put on another short? Well, the answer is actually yes to that question. All right. And the way that I do it is, let's say I have 100 shares long and I've been long for a while. And now I get a short-term reversal trade where the stop and the target are inside of my bigger trade stop and target. Okay, so what does that mean? Well, yeah, I don't know if Tesla's the right stock to use here, but basically, let's say that I've got $100 stop and $120 target, profit target. Okay. And let's say now I've got a sell at 118 with a target of 105. Okay. That will be a smaller position for me. Okay. Because it's tighter than my other one. So let's say I have on 20 shares. I'll exit 10 of those shares at my sell target, at my short trade. And then I enter that into the other sheet as being short 10. Okay, so I'm long 20 in one sheet, short 10 in the other. Okay, now it trickles down a little bit. I start losing money in my long-term trade, but I'm making money in my short-term trade. Now it hits my target. I take my profits there, and now I'm back long 20 again, but I've got some money in the bank at the same time. And then let's say it goes sideways and turns back up. You can only do that if you're tracking trades in separate spreadsheets. Otherwise, it's too much to keep track of in your head. Okay, it's way too much to keep track of. So it looks to your broker, to anyone else looking at it, like you covered part of your Tesla long. But on your spreadsheets, you didn't. You put on a small Tesla short, right? The fact is you did cover part of your Tesla long and buy it back lower. But the reason you did it is your process gave you a small short trade while you were in the middle of a longer term long trade. Let's do a whole session on that, Badish. I think that's a good thing. I will pull up spreadsheets and I will show you exactly what I'm talking about. All right, but we'll do that as a full session because that's probably more, I'm realizing it's probably more complex. But Chris actually said, so did you literally sell 10 of your 20? Yes, I sell 10 of my 20 and I don't borrow because that's a synthetic short trade. And you don't have to worry about it then. So we'll do an entire session on that, and I'll build a whole new spreadsheet on it to kind of show you what I mean. I'm not going to put live data in there. I'll just put examples in there rather than do live data. You guys can pick a stock if you want. I'll let you guys pick the stock. Either put it in the chat now, or you can go ahead and send it to Badish. But give me time to build the spreadsheet. Okay.
Let's do that. Thanks for your thoughts, Bob. We're coming at the end of our session today, but before we wrap up, I would like to ask about the common mistakes you've seen or to avoid when developing a trading process to minimize our losses, and your final thoughts about for today's session before we wrap up.
All right. Number one, the first mistake, using dollars as your fixed stop loss. That has been tried by 100% of traders that ever tried. Okay. I don't want to lose more than $50. So you place your stop at $50. No thought about position size, no thought about what the price action is, no thought about what the at the money straddle is showing you about the earnings move. No thought to anything else. $50, that's where my stop is. That is dumb. That is dumb. Because in a stock like, in a stock like NVIDIA, which can jump 10, 12% in a day, that's versus a stock like General Electric, which can jump $1 a day, completely different dynamics. So that's the first mistake. Number two, thinking that somehow you matter to the market. Okay. The market is like the movie The Matrix. The market is like Agent Smith. The market doesn't care about you. All right. So you have to protect yourself from what the market is doing. Okay. You have to do it.